Alright, so right now I am scrolling through Starbucks Corporation financial statements, and if I wanted to, I could look at Coca-Cola's financial statements, Apple's financial statements, Google's financial statements. Their name in their charter is Alphabet Inc. I could also show you Facebook's financial statements, their income statement, their balance sheet. I could do this for Microsoft, Amazon, and a whole bunch of other companies. So at the end of this video, I'm going to show you how you can access these statements and how you can access the financial statements of any other company you want, so long as they are traded on a stock exchange. I'll also tell you a little bit about the stock market, and I'll tell you why the government requires these companies to publicize these financial statements so that anyone, including you and me, could look at them. But first, let's get into financial statement basics. So we're going to cover the financial statement basics today. I'm going to tell you what the four main financial statements are and what their purpose is. The first one is the income statement. The second one is the statement of retained earnings. The third one is the balance sheet. And the fourth one is the statement of cash flows. The purpose of financial statements is to tell others how the company is performing financially. Now, I mentioned that there are four main financial statements in financial accounting. The first one that you will learn about is called the income statement. The purpose of this statement is to tell you how profitable the company is. It will also tell you if the company lost any money in a given period of time. But what you need to know right now is that the income statement, the main purpose is to tell you and others how profitable the company is. Okay, the purpose of the statement of retained earnings is to tell you what the company's profit is doing. There's two things that the company's profit will do. Number one, all of this profit will go into the company's savings account called retained earnings. RE for retained earnings. Retained earnings is a savings account. Okay? All of the profit in a given period of time, say 3 months or a year, will go into this account called retained earnings. It's a savings account. Okay? The second thing that it will do, the second thing that companies will do with profit is they'll put a portion of it, like say 50%, they'll put that into retained earnings. Then they'll also pay the owners the other portion of it. So 50% goes to the owners. I want to tell you that this 50%, it doesn't have to be 50%, it could be 90 and 10, okay? Okay. Now, basically what the balance sheet is going to do, it's going to list all of the company's accounts. It's going to list the balance of every one of the company's accounts. So it's basically like taking a screenshot of your bank account and then sending it to your friend. That's what a balance sheet is, except companies have a lot of accounts, way more than you have. It's just a sheet full of all of the balances of their accounts. Okay, just think of it that way. I'll explain more about the balance sheet in another video, but all you have to know, just think of it as a screenshot of all of the company's accounts on one piece of paper. Alright? It's like me, I have 2 bank accounts. I give you a sheet of paper and I put the balance of one bank account and then the balance of the other bank account. That's my balance sheet in a way. Okay? Okay. The last statement that you will learn about in Financial Accounting 1 or Principles of Accounting 1, basically the same class, is called the Statement of Cash Flows. Okay? The Statement of Cash Flows, its purpose is to tell you what the company's cash is doing. Okay? It's divided up into 3 sections on a piece of paper. It's divided up into cash flows from operations, cash flows from investing activities, and cash flows from financing activities. Now, all no matter which activity it is, there's going to be cash flowing into the company and cash flowing out of the company. That's why we call it the statement of cash flows. There's money flowing in and money flowing out of each one of these activities, right? You could say, for instance, the company uses cash to invest in a new building. That's called an investing activity. Basically, what the statement's going to tell you is that we spent $100,000 on a new building. $100,000 left our company, right? And say they borrow $100,000 from a bank. Well, $100,000 flowed into their company. So basically, all the statement of cash flow is telling you is what the company's cash is doing. Is where's cash flowing out and where's cash flowing out and where's cash flowing into the company. Okay? Now let's do a quick review. So, how profitable is the company? The income statement. What is the company's profit doing? Retained earnings. What are all the balances of the company's accounts? The balance sheet, a screenshot of all the company's accounts. And then what is the company's cash doing? The statement of cash flows is very important. Let me explain why the cash flow statement is so important. This is because cash is not equal to profit. Now, this is a concept you're going to learn about later on in school. That's why I'm telling you about it now, while you're learning about the basics or the fundamentals of the cash flow statement. It's very important. The sole reason why we have it is because cash is not equal to profit. Okay, so a company can be very profitable, right? But they could also have little to no cash, and that is a bad thing. Let me explain why profit is not equal to cash. Profit is made up of two kinds of money. Number one is cash, and number two is called accounts receivable. Accounts receivable. We call it AR in accounting, or that's an abbreviation for it. So let me explain this. Let's say I sell this marker to you for $5, and I stole this marker, so it's all profit to me, okay? I get $5 profit from you. But you told me that you could only pay me half of this $5 in cash, and you also told me that you would give me the other half later on. This happens in businesses all the time. Actually, what's more likely to happen is that a business will sell to another business on account, which means they sell on credit, and they'll say, here, you can take all of these markers and pay us later. So they'll do 100% of it on account. But you and me, we're doing 50%. Today, you're going to give me $2.50 in cash, and you promise to pay me $2.50 at a later date. This is why profit is not equal to cash, because even though I'm going to have $5 profit, this is a transaction, okay, no matter what. Even though I have $5 profit, I do not have $5 cash. I only got $2.50 cash right now, and I got $2.50 coming in later, okay? So that's why profit doesn't equal cash. That's why the statement of cash flows is so important. We need to know what the company's cash is doing, okay? Another key thing to note here is that, you know how I told you that profit goes into retained earnings? Well, retained earnings is not equal to cash either, because retained earnings is basically profit. So, you know that profit is not equal to cash, retained earnings isn't equal to cash either, okay?
Let's try to do this quickly. Why can I look at these financial statements? Well, these companies share one thing in common. They are publicly traded corporations, and they are also publicly owned corporations. Now, a quick way to determine whether a company is a publicly traded corporation is to type the company's name into Google followed by the word stock, and then search. If you can buy this company's stock on a stock exchange, such as the New York Stock Exchange or the NASDAQ, then this company is a publicly traded corporation, and it is also owned by the public. Now, what do I mean by that? If you buy a share of stock in Walmart, congratulations, you are now an owner of Walmart. You could buy one share of ownership in Walmart for $114.26. Beware that you would be a very tiny fish in an ocean of owners, because Walmart has about 2.85 billion shares of stock available on the stock market. Quick note here, just so we're clear, one share of stock is equal to one share of ownership in the company. So when you buy stock, you're essentially buying a percentage of ownership in that company. Now, you might be surprised to know that Facebook is no longer owned by its Harvard founders. That is because Facebook had an initial public offering in 2012, also known as an IPO. An IPO is when a company sells its stock to the public for the very first time. Now, let's take Tesla real quick as an example. Let's say that Elon Musk is the only owner of Tesla before his initial public offering. So let's say this square represents, or this rectangle rather, represents his ownership, his 100% ownership in Tesla before he had an IPO. Now, essentially what he did on this day was divided his ownership, his 100% ownership, into 172 million shares of stock. And then he sold a large part of that stock to the general public. He probably kept some of the stock for himself as well. Now, when a company goes public, the government steps in and says you have to publicize financial statements for potential investors to look at, because you can look at these financial statements and analyze them and determine whether or not you want to invest in a company like Tesla. Now, if you would have invested in Tesla several months ago, you would have lost a lot of money, because Tesla's stock used to be worth about more than $300 several months ago. So it has dropped in value. Now, if you would have invested in Google at its initial public offering in 2004, then you would probably be much richer than you were then. Let's say you invested $1,000 into Google stock in 2004. In 2016, you'd have about $18,000, or more than $18,000 rather. Now, if you would have invested $100,000 in Google in 2014, the value of that $100,000 would have risen to over $1.8 million by 2016. This is the beauty of the stock market. Now, I would not recommend that you go start investing in the stock market until you know a thing or two about it. But again, this is why you can look at these financial statements. And the easiest way to look at these financial statements is to simply go to Google and type in the name of the company followed by, let's call this a word, 10K. So if you wanted to look at Apple's financial statements, you would just go to Google, type in the name of the company, Apple, followed by the word 10K. Then you will get several listings. You might find that the company will allow you to look at their financial statements on their website, but you can always depend on the SEC, the Securities and Exchange Commission, to publicize or make these documents readily available for you. All you have to do is click on the link, and there you have it. You can explore the financial statements of any company that is publicly traded. All right, guys, have a good one.